Bonds explained. Simply why smart investors respect fixed income. When people hear the word bonds, many lose interest immediately. They say bonds are boring. Bonds give low returns. Bonds are for old people. Let me tell you calmly, this thinking has destroyed more wealth than any market crash. Today I will explain bonds in very simple language. And after this video, you will understand why institutions love bonds and why wise investors respect them. Let us start from the beginning. A bond is not complicated. A bond is a loan. You lend money and you get interest. That is all. When you buy a bond, you are not owning a business. You are becoming a lender. The borrower can be a government, a corporation, or an institution. Now here is the first big difference between stocks and bonds. Stockholders are owners. Bondholders are lenders. If a company struggles, owners suffer first, lenders get paid first. This one difference explains why bonds exist. Now let me ask you something. If you are retired or close to retirement, what matters more, fast growth or steady income? For most people, the answer is peace of mind. That is what bonds are designed to provide. Now let us talk about government bonds. Government bonds are considered safer because governments can tax and print money. This does not mean risk-free, but relatively stable. That is why pension funds, insurance companies, and retirement plans hold large amounts of bonds. Now let us talk about corporate bonds. Corporate bonds usually pay higher interest because companies can fail. Higher return means higher risk. This trade-off never disappears. Anyone promising high bond returns without risk is not telling the full truth. Now, let me explain interest rates. Very simply, when interest rates go up, bond prices go down. When interest rates go down, bond prices go up. This relationship confuses many people. But think of it this way. If new bonds pay higher interest, old bonds become less attractive, so their price falls. This is normal. This is not manipulation. Now here is an important warning. Many people buy bonds and then panic when prices fluctuate, but most bond investors do not care about daily price. They care about interest income and maturity value. This is a very different mindset from stock investing. Now let me talk directly to senior investors. Bonds are not meant to make you rich. Bonds are meant to protect what you already have. They reduce volatility. They provide predictability. They support regular income. Ignoring bonds completely is like driving without brakes. Now let me summarize with 3 clear truths. First, bonds are about stability, not excitement. Second, higher yield always comes with higher risk. Third, a balanced portfolio respects fixed income. In the coming videos, I will explain how bonds fit into a complete portfolio, how interest rate cycles affect you, and how seniors should think about risk. If this video brought clarity, please like, please share, and write in comments. Do you invest in bonds or only in stocks? I personally read comments. Thank you for listening.